I look at the housing market, and year on year, the rate of change of housing is actually now stabilized and sort of rising with the forward-looking indicators for ISM. And also, most of the interest payment charts, a lot of that is mortgages, and the mortgage stuff is fixed rate. So there's actually a very small amount of that seems to be an issue going forward. So I'm not overly concerned by that. When I look at the business cycle, I use the ISM survey, Institute of Supply Management. I've got that goes back to 1947, and you can use the Treasury survey that goes back to 1870. Works pretty well. Gives you a decent idea. So here's how I'm just using my recent GMI monthly, and I haven't got all the full economic charts in this. But basically, now when the ISM gets below 50, you're starting to look for a recession. It's been below 50 all year. Most of the forward-looking indicators were showing this all through 2022, that we should be slow now. If I look at the forward-looking indicator just by using the ISM alone, just inverting it, because it's such a perfect cycle right now, we've been following this pattern all the way. So my idea of the business cycle, and we use financial conditions index and several hundred charts based around the business cycle, actually several thousand, is for us, the business cycle just gets stronger from here on in. That whether we got a recession or didn't get a recession, it was priced into growth assets last year in 2022, and in 2023 it got priced into stuff like the Russell 2000 and cyclicals, and I think most of it should continue higher. So I don't really see the evidence of it being a late cycle. I think it's very difficult to get rid of the mega trends of technology right now, and with a liquidity cycle backing it. But we have to see, right? You could be right. Look, there's a probability that you could front-end load something, and then in which case some of these riskier markets don't follow through the rest of the business cycle. I give that a 20% chance. I give a 60% chance that this is just a normal cycle that we know from crypto and macro. We tack on another 100% plus in the NASDAQ, and we tack on another 500% in crypto plus, broadly across the board. And there's the other thing, which is this is going to be a much bigger bubble into 2025 because kind of all the elements are in line. Now, I think there's a 20% chance of that. That could have a longer hangover for the next cycle, but I don't see the cycle has changed here. It's been like clockwork, based around the debt cycle. It's been managed the same way every single time. Interest rates go up, growth slows, the Fed or one of the other central banks stimulates, it kind of bottoms the cycle out. I think most assets priced in a recession last year in 2022. Crypto certainly did. The year-on-year rate of change of crypto and the NASDAQ were perfectly in line with our financial conditions index. Financial conditions index is loosening rapidly, and everything follows that. This is the next big trade, amongst the majors, is this switch. And if I look at the chart pattern, it's this giant wedge over a period of time. In fact, we showed it on the show last time, this giant wedge pattern in the ETH Bitcoin cross on the monthly chart. Then, I use a lot of DMARC for my technical analysis. It gave daily, weekly, and very soon a monthly 9 count. Okay, the economy slows down because rates have gone up and there's so much debt. So fine, the economy slows down a bit and they use it. It's the same time as the election cycle as well. It's all the same cycle. Bitcoin halving cycle, it's all the same time. They get interest rates down and they engineer some way of using the balance sheet. But that's generally what they do. And that's why election years tend to be pretty good years, which is why I still struggle to get bearish for 2025, because even if the economy slows in an election year, they'll just stimulate more. And that's the struggle I have, is that, if you have a blow off top and some, I've seen some of your stuff, like you could have a 1929 style thing. I'm like, I don't think you can, because they just print money and optically it debases the currency. So how do you get that? Again, if you've got the two biggest assets, just think of Gary's mind, right? Gary Gensler. His mind is, let's get these behind Wall Street. Let's give Wall Street share of this. Let's get it into my jurisdiction. Then, of course, you want the second largest asset. The rest will probably leave to us for a while until we get a change of SEC or whatever. But he wants to make sure that they've kind of got the guardrails around the two big ones. So I think they want it.
So is it safe to say that probably the ETH trade right now is probably the from a risk return point of view, sounds like the ETH trade is the lowest risk trade on the market at the moment, if our thesis is right?
You've got a perfect place to put a stop loss. You can even size the trade well. It's actually just a lovely, lovely opportunity. You don't get many of these like this, particularly where daily, weekly, monthly charts kind of line up. It's like they usually have a very high probability of success.
I'm going to move a little bit lower down the risk curve, or a little bit higher up the risk curve, and talk about Solana. So this has been, the reason why I'm asking is because you've had a trade where Sol has appreciated from a low of like $13 and it's trading at about $100 now, give or take. Okay, so now I'm going to ask you guys the same question. Would you be putting money into ETH now, or would you be putting money into Sol now if you had to choose one?
Doesn't really look like there's anything to stop that. A bit of consolidation that breaks the new highs. Bitcoin and Solana lag for a bit. We do a nice little cup and handle, and then it just explodes to new all-time highs versus ETH. So this is global liquidity from all the major central banks: the Fed, the BOJ, the PBOC, the ECB, and the Bank of England. And basically, they were all withdrawing liquidity. But I noticed that liquidity had bottomed in year-on-year measures and other forms back in. It actually started bottoming in June, which got me into starting to rebuy Ethereum in the lows there, and then fully confirmed the bottom to me in my measures in October, November. So that's when I really kind of loaded up in technology and the full crypto. And for me, that these are forecastable, readable cycles based around the debt refi cycle. Look, everything has a possibility and everything has a probability. I don't see where the systemic problem is. We all understand how big the debt is, but we figured out, don't forget, households have been deleveraging now since 2008. Corporates access the bond market, and there's still a starvation for yield that comes out of the pension funds that supports it. And if we look at what the Federal Reserve are doing, they want to lower interest rates anyway. And they've been injecting liquidity into the system. I just have a faith that everything changed in 2008 and that most people don't understand this. And maybe I'm wrong. So what they're doing is mutualizing the payment of interest rates amongst the people by clipping the currency, essentially, by debasing the currency. So it's not pushing money into the system, giving us more money to spend. It's the optical thing, like the Venezuelan stock market. The currency devalues, the price goes up, right? Same with the Weimar Republic. When you look at the German stock market, it went up in a straight line.